Welcome into the Invest Well Show. I'm your host, Michael Wall, joined today with a great guest, actually lead advisor and portfolio manager for U.S. Private Wealth and Wall Private Wealth. And we're talking today about the idea of new year, new investments. The question is, the calendar has changed. I don't know if you knew that or not, but it is now 2023. So if you're writing old school checks, make sure you don't put 22 up there on the upper right. I've done that before. Don't do that. It won't work, right? Make sure you put 2023. The question, though, is in relation to your investments, should you maybe look for some different strategy? The market was significantly down last year. Not everybody was down, but the market was down, and many folks out there in the market and many folks out there in the investment world, we'll call it investment land today, have been negative. Again, but there's been some strategy that actually was positive. So the question is, should you, because it's a new year, look at changing your investment structure? New year, new investments. We're going to talk about it on the Invest Well Show. All right, so here we are. Dalton, first off, thanks for taking a minute out of the day. I know you got a busy day to join us on the show. Full disclosure, you guys know I have multiple companies, and one of the things that we've done for 20-plus years is help families protect, grow, reduce taxes. They're also the sponsors of these shows. That's how these shows are powered. The goal is to share information. But I wanted to bring Dalton in because his feet is pretty close to the fire as far as what's happening, not only from our portfolio directly for our families that we're serving, but also what's happening with some of the news that's coming out there today. We've seen layoffs, Dalton, from big companies like Goldman Sachs and others. We've seen conversation about what's happening with the Fed, whether or not they're going to raise rates again or not. So let's take a minute and just jump in and unpack some of those things that we're seeing now as we're recording this January 12th.
Yeah, so obviously the question, I think, is kind of shifted at this point to not if the Fed is going to raise interest rates, but by how much and how frequently. And, they're still trying to get their inflation number down to the target 2%. Obviously, that's a big, important role for them to make sure there's, fair employment and then also low inflation, right? So around their target 2%. So the question has really become, how much are they going to raise it by? Obviously, end of the month, people are expecting 25 basis point rate hike, which is 25% of 1% for people who aren't familiar with that term. But the question could be 50 basis points. So we don't know yet, obviously. But, really trying to keep a focus on not specifically the Fed, but the overarching theme, which is there's still obviously inflation out there. And the idea is that we need to bring that down to the 2% mark.
Yeah, and we know that consumer prices fell 0.1% in December, which is almost nothing, but it shows a little bit of a slowdown, right?
Yeah, a little bit.
And that's what they're trying to do. And a lot of times I know many of you out there, as you look at this, you think about things like, where does this whole inflation thing come from? What is the Fed really all about? What is the purpose? What are the goal? You may not know, but the Fed's primary job is to keep inflation intact. That's really what they do. That's their purpose. That's their goal, to help facilitate that, as well as other monetary policy and things like that. But, when we take a look at slowdown and we take a look at growth, I know there's a lot of conversation, Dalton, around whether or not this inflation that we're seeing has really been manipulated in some ways or even created in some ways. When you talk about some of the slowdown that happened from some of the things we've seen in past.
COVID.
Yeah, and we talk about the idea of supply chain and all of this other stuff.
Right.
That just warrants the reality that this is often the reason some of these things have occurred, along with the fact that we just have a workforce today that is not really interested in putting the kind of work, being diligent and working hard. But in relation to some of the other things that we're seeing, and I think this is important, we want to talk to you about some things that we're seeing with big companies. What are they doing? What is the footprint of what some of these companies are doing? And Dalton, we're seeing a lot of these companies, and by the way, we're going to talk a little later in the show what you should be thinking about and why this affects directly your investments and what you should be thinking about to potentially shift, change, alter your investments to really be prepared, whether things, currency gets tokenized, which was referred to by Larry from BlackRock.
CBDC, yeah.
Yeah, and some of the other things. But let's talk about some of the layoffs that we're seeing with some of these larger companies.
Yeah, so obviously moving into the lane of a recession, right? If we're not there already, we're moving into that lane, unfortunately.
And what does that mean for those out there listening?
Well, recession, technical technically means consecutive months of negative GDP.
Right.
But we're moving into that lane where it's starting to become not the fears that inflation is going to become entrenched, right? Mm-hmm. And so that's what the Fed is trying to navigate and make sure that inflation isn't here to stay. Mm-hmm. So when it comes to the layoffs, you're primarily looking at banking, so big banking, and then also big tech, mm-hmm. right? So. And primarily it's from the high interest rates that are coming from the Fed. So they're raising interest rates. We're about 4.25% to 4.5% federal interest rates right now. And it's looking like that's going to continue to go over probably over 5%.
Yeah, and I was surprised when we got a kind of a wire through that, Goldman laid off 3,500 employees, Goldman Sachs. I mean, mm-hmm. that's a big deal.
It is a big deal, and it's just kind of reflective of these companies trying to cut expenses right now and really weather the storm. So when that's happening, we obviously want to take a step back with the portfolio and make sure we're buying into things that have more value and aren't highly focused towards speculation or growth.
So if people are in a place right now where their investments are primarily all in the markets,
right,
and a lot of folks out there that are that way, there might mm-hmm. be some that have elements of real estate, but it's bought potentially through a publicly traded REIT, possibly. Sure. That's fully liquid. That's a benefit of it, but mm-hmm. the disadvantage is it's kind of correlated with the overall markets, right? If the market's a rising tide will lift all boats.
That's exactly
and when the water goes out, it's going out for everybody. So what are you seeing right now are some things that investors should be thinking about as they're trying to commandeer their wealth, a little bit differently for the future?
So one of the things I've been thinking about, and obviously I actually brought it up on a meeting today with a client we were having, and the idea is that billions of dollars moved off of public markets last year and into things like alternative investments, hedge funds, real estate, private equity, things like that. And that's focused around what we've been doing for a long time. You know that, obviously. But, following the big money, right? Because people know, some of those large fund managers know where things are starting to move in terms of a global recession, mm-hmm. potentially. So they're positioning themselves, and they've already done that. So if you're at that point where you're reevaluating now, I think you need to be a little bit more proactive, honestly, with what you're doing and make sure you're positioning well for the future, because you don't want to be playing catch up, once a recession does technically hit.
And I think it's important because, what happens, Dalton, a lot of times is investors, unfortunately, it's kind of like the turtle or whatever, or the rabbit, or whatever it is that you put in the pot of water. Mm-hmm. I can't remember what it's called right now. Put it in the pot of water, it gets warmer. David, our producer's over here looking at me, smile, laughing at me. But I can't. Put it in the pot of water, mm-hmm. and it gets a little bit warm. It gets a little bit warm. And it ends up cooking in the pot because it's comfortable with it, right?
Mm-hmm.
And so similarly with investments, what happens is a lot of times investors or people. So mm-hmm. if you're listening to this out there, tune in right now. If you're watching this out there, tune in right now. You can often find yourself in a place where you are suffering from financial amnesia, right? You're literally in a place where you're forgetting, which is one of the chapters in the mm-hmm. book that I wrote, Retire Once, Retire Well, but you're forgetting what happened in the past, right? We sometimes can focus just on today and tomorrow and next week. Mm-hmm. The past is important. We don't want to live there. We don't want to stay there, but we do want to learn from it and look to try and improve. And so what happens a lot of times is, people are in a place where the sentiment from most mm-hmm. of the financial industry, most advisors, most firms, regardless of where they've come from, whether they're newer in the space or older in the space, a lot of firms have had some element of working for a larger firm at some time in their career. Now, I never had that. I started independent all the way. Mm-hmm. But when they have that larger firm perspective, it's really a Wall Street-driven perspective.
It is.
The markets, mm-hmm. the stock markets, and that's really the only game in town. Sure. And unfortunately, what's happened is the overall economy has shifted. Investment philosophy has shifted. And so how important is that right now for investors, Dalton, to be saying, okay, maybe I did things this way in the past, mm-hmm. but I really need to be rethinking what I'm doing in the future, because the markets today are different than they were in the 2000s and
Definitely.
90s and et cetera, et cetera.
Definitely. Well, that's always the name of the game with investing. You always got to be thinking about what's shifting and moving, but you hit points in time where there's really fundamental shifts, right? And I think we've kind of reached that point with coming through COVID, some of the economic issues that we've had, digital assets, right? Mm-hmm. So the idea of a CBDC, who knows if that'll happen, but there's a shift towards more and more blockchain-focused technology that being incorporated in a lot of the businesses. We've looked at that with major corporations.
We're seeing large companies and endowments and universities invest billions of dollars in blockchain technology. So it's not going away. By the way, if you looked at that and you said, oh my gosh, I saw FTX and that scared me from blockchain and even digital currency, et cetera, et cetera, et cetera. At the end of the day, I really believe that was a little bit of a smoke and mirrors play, Dalton, because when you take a look at it, I mean, they had a valuation that wasn't real, right? And then they went and borrowed on that valuation. And then all of a sudden, the loan basically got called in some aspects, or people wanted to sell shares or different things like that. And they're like, well, you know, the value is not really real, right? And so there's nothing there. And all of a sudden, we find that the money's been spent here and been spent there and been spent here. And somebody had too many Twinkies along the way is the bottom line. So, you know, that doesn't necessarily mean that the fundamental or underlying crypto/digital currency market has changed or gone away. No. It did, I believe, add value to the space because it weeded out some of those meme coins and things that then actually have real utility. So when you talk about tokenization of assets and things like that, I mean, we are moving towards a digital currency. And I know one of the things that we've talked about offhand and we've done directly and you've been involved in as well is preparing families, preparing clients for that. So as investors are looking at that, what would you say one or two things they need to be thinking about as currency potentially shifts to be tokenized or digitized in some capacity? What does that look like in your mindset? People need to really be thinking about to stay ahead of the game.
Well, so a few things there. I think number one, if you're a traditional 60-40 split between stocks and bonds, number one, I don't really like fixed income personally this year, or bonds, I should say, just based off of where interest rates are headed, number one. Market-wise, I think that can still be diversified and look for value there. Obviously, treading a little bit more lightly as we're still having high inflation. But thinking about moving assets obviously off market is one thing for sure. Private equity, real estate is still something that as long as you're specific and focused, right? So not just broad generalization of real estate, but specific and focused with what you want to buy. And then the other thing is obviously something that you were just mentioning, which is digital assets, and not just for currency. When BlackRock was speaking recently, CEO of BlackRock, one of the big things was with securitization too. So with equities, essentially moving more towards that token space. Why? Because it's more efficient. You don't have as many of the middlemen as you would have traditionally.
The market makers, the spread, a lot of that stuff in the middle, the fat gets thrown out.
Right.
Which is great for the investor.
It is great for the investor. That's obviously going to be something that's kind of long term, I see, happening over the years. So maybe that's not an immediate need for the portfolio, but I still think there's that shift that's happening right now, and you have to incorporate multiple assets in order to really capture return.
Well, and not only that, just to kind of start to land the plane here for you, a lot of people don't realize when you take a look at private equity, there's a variety of different ways to enter private equity, right?
Sure.
And so most traditional people, when they look at private equity, it's in a place where, it could be buying into private companies, it could be real estate. What we like in using private equity, obviously, is buying into private companies, and using a fund style structure, which gives flexibility. There's no debt on the play. There's opportunity for upside, potential. There's no capital calls, which is very attractive, especially when you look at traditional private equity. I mean, the last thing you want to do, by the way, is get into an investment, and you're there 6 months, a year and a half in, and the people that were creating the fund or creating, whatever you're invested in didn't do a great job of preparing really for what was needed from a capital stack perspective. And now they're like, hey, we're out of money, right? And if we don't raise capital, do a capital call with all of our investors and say, hey guys, we need more money in order for us to continue to go down the finish line to finish this. That's a bad place to be. Nobody wants to give money to a place that maybe wasn't done well with in the very beginning.
It's going to be a loss leader.
Looking at private equity in places and investing in places where you have liquidity after 1 year, where you're in a place where you have no capital call capability, and really nice returns, strong, low, mid-teen returns, annually. So these are things that we want to be looking at. Dalton, thanks so much for taking a few minutes. Any last thought that you want to share, just in overall general markets or trends that you're seeing that you believe are important for investors to be thinking about right now?
Yeah, short term, I still like, oil was one of the big plays last year, energy in general. And then, I think we're still could potentially have, high oil prices
Yeah.
by the barrel. Specifically, if China reopens, that'll be a big factor in the pace of how they do that. So I think oil is something that people should focus on. Focus on your conservative investments, the value based or commodities based. Get that in line, and then you can kind of look at some of the more maybe riskier asset classes.
Yeah, that's good. That's good thoughts. Thanks so much for taking some time
Absolutely.
again. Dalton Helvey, lead advisor and portfolio manager for U.S. Private Wealth, Wall Private Wealth. And as you know, I lead those companies as I wear other hats. But I just wanted to bring him on because I wanted to share some sentiment and thought as we're seeing kind of like feet to the fire as far as what's happening with investments, markets, trends, et cetera. And I think the biggest overriding theme, if you've heard me in the past and you hear me now talk about it, it's the idea of proactivity. That is so important. Most of you that are listening to this, maybe you're younger and you're growing your wealth. Maybe you're older and you have wealth, but you're working hard for what you have. And the last thing that we want to do is spend the time and the energy and the effort to work hard for what we have, build some wealth, have a portfolio that has some significant value, and then not really pay attention because we're just kind of using antiquated technology. It would be like, once you get a brand new car with brand new GPS that works flawlessly, or you get Siri that's working for you and you ask, to do this and that or whatever, and then you go back to the old flip phone that doesn't have that. If you've gotten used to some of the new tech and you go back to the old, you're like, gosh, this is a lot more antiquated and it's a lot harder. A lot of you are still investing with a flip phone mentality, and you're not actually caught up to the new generation of where things are. That's so important. We see that at our other firms when they're diving in and going through and having reviews on the portfolio. So I want to challenge you, if you have questions about what you're doing financially and to see if you qualify, whether you're a young professional making a higher income earnings, 500, 600, 700,000 or more, whether you're someone with 1.5 million or more. A private wealth division over at U.S. Private Wealth and Wall Private Wealth starts at 25 million, and then we have a pro athlete division. So there's several divisions that you may land in. My challenge to you to gain more information, to get more education, is to head over to leanonthewall.com and learn. Take some time and learn. Pick up a copy of my book, Retire Once, Retire Well. Listen, we have created these resources for people out there. Why? Here's what I know. Not everybody that listens to this show or watches what we do is going to be the right client for the financial firms that we have, and I get that. And that's why a lot of times I don't always talk about pushing to those firms. But one of the things I always want to be doing is sharing information and challenging people, challenging investors to educate themselves. The most empowering thing that you can do is learn more, become more proficient in what you're doing and why you're doing what you're doing. Be open to new ideas. Those things will help you grow in a capacity, in a way, maybe that you've never experienced before. And quite honestly, by doing that, and I think in a lot of ways, it'll aid and help bring a lot of peace of mind into your life. Why? Because you know that you're more researched, you're more focused, you've reached out, you've looking at and getting different ideas. Very, very important. Instead of just kind of being there and feeling somewhat like a victim when your advisor says, hey, hang in there, it's going to come back, these are going to be rocky markets, nothing we can do. Meanwhile, you're sitting there looking at your assets and investments and portfolio structure or family office structure and saying, gosh, I've worked all these years to build this. I don't want to just hang around and hope it works out. I really want to have a proactive plan. I want to challenge you to get that. Head over to leanonthewall.com. Listen, as always, my desire and goal for you is to be empowered and encouraged. Share this show. Take that cell phone out that you're maybe listening to this via podcast on, and share this show with someone that needs to hear it. Share this show with someone that you care about so they can start thinking a little bit differently about what they're doing. And as always, my desire is to help you live on purpose so you can live with purpose. Be blessed, and until next time, have a good one. Keep in mind, the information shared on this show is not to be considered investment advisory advice. For specific recommendations based on your situation, make sure you reach out to a professional, whether it be financial, accounting, tax, attorney, or whatever you may need to help you find the information necessary to make good decisions.